In the fast-paced world of mega real estate projects, being well-capitalized, well-connected, having a keen eye for value creation, and a stomach for risk will only get your foot in the door. Urban Real Estate Center has created a lecture series with leading professionals to offer you intimate, behind-the-scenes look at the driving forces in design, planning, marketing of iconic development projects in New York and Miami, where sophisticated uber luxury buyers bid on the most coveted real estate on the planet. Be inspired by an insightful conversation with the Oracle, who managed to sell his $39 billion portfolio at the time the largest real estate trade in history, on the eve of one of the gravest global economic meltdowns in the course of a century. Discover the forecasting analysis necessary to maneuver between the peaks and valleys of an economical cycles. Address the dedicated formation of joint venture partnership from CEO of public companies and learn negotiation techniques never before addressed outside the boardrooms from super lawyers. Learn the secrets of a globally recognized power broker with over 2,100 investment sales transactions valued north of $18 billion, operating in the world's most competitive market. Enter the domain of leading asset valuation specialist who has been advising national banks and public REITs for a decade. Venture through the life cycle of large-scale construction management and the complex task with hundreds of moving parts that can make or break even the most seasoned developer. Gain first-hand knowledge from the orchestrator of a $600 billion commercial mortgage-backed security industry that shifted the world of real estate finance from that day forward. We are Urban Real Estate Center, and this is our master course. Hello, welcome everyone. Thank you for joining us to Analyst Hour. My name is Joe Berko. I'm one of the founders of Urban Real Estate Master Course. And before we'll start Analysis Hour, we have with us some of our top analysts here, both Alex Macri and Andrew Milbank, that's going to be talking about analyzing and going through the Pro-forma as it relates to a specific project, give you the time to do questions and answers. I'm going to take a couple of minutes of your time. We have many guests with us today, not just current students. We've asked for a few of our students to participate in this class, but also we wanted to bring new individuals to hear about our program. So a little bit about us and about the course. So first of all, Urban is essentially a collaboration between the US operation and an off-sea operation. So we have a global outreach, the conversation, the events. Companies have started since 2016. We have over 3,000 members, both here, stateside, and on a global scale. And we've employed the knowledge, the skills of global professionals, top professionals in their field. Our goal is always to provide you with immersive mentoring and training framework led by top real estate professionals to elevate your career and to help you go through your day-to-day business questions, challenges that you have. I think one of the things that's unique about Urban, and we've been called many things, one of my favorite is we've been called disruptors in the real estate education arena. And why is that? If you think about normal education, the kind of education we're all used to and accustomed to, most education is done in classroom setting, one individuals, no doubt a professional, no doubt a very smart individual will be sitting there and will convey textbook theories, will convey not the type of dry material, for the most part, the type of dry material that we're grown accustomed to. And so you will be in a class and your mind will start drifting off to other places and lose interest over time. What we've done is we've taken the education to a very different level. You'll hear from, at this point, close to 30 professionals, top of their field. Some of the individuals have raised money to, tremendous amount, some of the largest in the United States. Some of the individuals that will share their insights and experiences are individuals that sold some of the largest projects in the United States, maybe even global. And you'll hear it firsthand. It doesn't end there. The theoretical part is only the beginning. We'll also bring those individuals to have conversations with you, to have you ask questions and have an interaction. We've also added the concept of the physical training. We'll look into your project, we'll inspire you to bring your projects, and we'll work on your project, whether it is you're raising capital, whether it is you're looking to buy an investment property, whether you buy an investment property and you need to analyze or go through asset management. All those aspects will be yours to take from the wealth of information that we bring to each and every one of our courses. We say at Urban Real Estate Center that when the course ends, the real learning starts. We have the analyst hour, and we have a team of analysts that will work with you throughout the course of 6 months in order to take your projects and elevate them, in order to go through the challenges, whether it is negotiations, whether it is the legal, each and every aspect of real estate. It's all designed for you to be successful. So as I mentioned, the mentoring part is extremely important to us. You'll have access to that, access to training by top professionals, proactive networking. We've created a community. In that community, you can find everything you're looking for. We have bankers, investment bankers, developers, architects, attorneys, all those individuals. The entire industry is in fact encapsulated into our course, and the community is growing quite exponentially. We're very proud of it. Some of the names you might have recognized, many of them are frontline. Many of them you've seen in magazines like The Real Deal, front page or back page, where their life stories. Who stands out essentially are the type of individuals that we brought on board. So anyone from bankers to top real estate brokers, capital raisers, the sort of information that is available not just during the class, but also for you as a library to go through if there's parts that you miss and there's parts that you want to revisit. I think we've touched those points, and we're really excited about this. We have right now 5 different courses that focus on development, finance, analysis, multifamily, and the overall scope of capital raise. And what we're doing right now is we're taking the best and the absolute capsulizing the best of each and every one of those courses into this one course, short course that will follow by teaming you up with the right type of professionals to help you throughout your following months. Weekly training session, very similar to the one we're about to go through today, in order to help you with your pitches and your deck books are available to you. And I certainly hope that you'll find this program inspiring, interesting, and it will be the type of program that you will take on in order to push and elevate your business, your career forward. Thank you very much. And without further ado, I'll pass along to our analysts, Andrew and Alex, to start the analyst hour.
Perfect. Thank you, Joe. Again, welcome to everyone. We'll start by going through an Excel. I'm going to share the screen now. So this is a example of an actual deal that we've been looking at. So I'm going to kind of take you through the various portions of this Excel template and how we arrive at certain conclusions, how we make certain assumptions, what they all mean, how they all tie together. So hopefully you'll be able to use this as a practical example moving forward in your own work. So I'll start with, kind of this obviously this dashboard, right? This is our template. This is something that we provide to students of the course. It's something that we've come up with over years and years of trial and error and tweaks and modifications. Really allows us to see, as the dashboard says, everything you'd need to know about a particular deal in one simple page, right? It's consistent, it's fairly simple, and it's pulling information from other tabs to get certain assumptions in here. And then we also make certain assumptions of our own, right? So you see kind of anything that's got, yellow and blue is a variable tab that we're changing. Everything else is generally pulled from another tab. Okay, so for every single one of these cells right here in this Excel, there's a lot of other things that go into that. It could be, a tab that's got 5 bits of information. It could be a tab that's got, 300 pieces of information. Okay, so this is what the sponsor provided to us, right? A couple of tabs in here. And I'll take a quick second, right? So just for those that are unaware of Astor Realty Capital, right? We are a real estate private equity firm investing preferred equity and LP equity into real estate projects throughout the US. We've got about 3 million square feet that we've invested in about 12 different markets. We've got offices in New York, Miami, and Phoenix. Have about 20 professionals on our staff, from originations to negotiation and closing, marketing and investor relations, asset management, legal. So this is what Alex and I do every day alongside Joe, is analyzing deals that we want to invest in, right? So this is something that again we're doing all day long, and this is kind of how we do that, right? So starting at the kind of this very top quadrant, right off the bat, we want to understand the capital stack of the deal, right? And normally this is going to be preceded by from the sponsor, sort of an offering memorandum, as well as their Excel on the deal. And we're taking all of that information and synthesizing it into this one tab here, right? So understanding the sources for the capital stack, right? Capital stack meaning sources and uses. Okay, what is the leverage that we're looking at? Is it 65% leverage, 75% leverage? Right? All things being equal, a 25% return to us at 65% leverage would potentially be preferable to 25% return to us at 75% leverage. Okay, so we want to understand kind of the risk level of the deal, who that lender is, what the terms are. This is maybe no more relevant today than it's been in the past, right? The Fed today just raised interest rates another 75 basis points. So the debt markets have been in flux now for 3 to 4 months. You could argue a little bit longer than that even. So understanding the debt component of a deal is critical, right? It's typically going to make up anywhere from 65 to 80% of the capital for the deal. That's always going to be a critical component. As a developer, you really need to understand what kind of lender you're dealing with, what are the terms, how do they affect your project? And as an investor, where do the potential risks come from? Is it a fixed rate loan, a floating rate loan? What's the term of the loan? How long does that loan go for? Right, so very simple line item in this Excel, right? But something that's going to be drawn typically from a tab in the Excel that has all of that information you're looking for, or it's going to be in the offering memorandum. Okay, understanding the equity, right? How much common equity, how much GP equity, right? Something that we again kind of break down further here to understand. And this is going to be coming from both angles. From a developer side, how much money do you want to bring to the table, right? So this is your kind of starting point on the negotiations, right? It's a big point. If you want to start at 5% or 10% equity, right? you're kind of starting the negotiations right off the bat with what you send to a potential investor. You're also starting the negotiations with what you send to a lender, letting them know how much money you have invested in the deal, how much skin you have in the game. Okay. You're also then obviously letting your potential investor know how much money you are seeking from them, right? You want to be very simple and clear and to the point with what your request is on the developer side. Or if you're an investor, you're raising capital, you want to be able to clearly show what your position is, where it is in the stack, and how you are potentially addressing any risks from there. I'll take a quick second. I see a couple questions in the chat. I want to just make sure that we're making this as interactive as possible. I see from Malik, yes, this Excel sheet is available as a as a template, and I would encourage you, if you hit the raise hand feature as well. So either drop a message in the chat or use the raise hand feature, and it should highlight you if you have any questions as we're going through this. Okay, the next piece here, the uses, are also very critical because you're going to see. Actually, we'll pause real quick. John, you had a question? You're muted, John.
I'm sorry. I just raised hand based on what you said for a copy of the template. Misheard.
Okay, perfect. No problem. So we'll if you just drop some in the chat, or if you email Valerie or Yost or whoever you spoke with, we'll make sure to get a copy out to you. Okay. The uses, right? Understanding what is the money actually being used for? What is this project? Where are these costs going? Right. And it's not just, oh, here's the land cost, 7 million. What is the land cost per foot? What is the land cost per unit? Because we can automatically use this as a comparison tool versus other land trades that we've seen in the market. This particular deal happens to be in Coral Gables, very, very affluent, strong rental market in Miami, $50,000 a unit, pretty good land basis for Coral Gables. If this were in a different market, maybe I want to see that at $30,000 per unit. Or if this is in, for those of you familiar with more of the New York region, right, where I'm from, you'd expect this to be, 100, 150,000 per unit potentially, right, where prices are, just a bit higher here in, in New York than they would be in other parts of the country. Okay, so right off the bat, we're kind of using this to understand, is this a strong deal based on the land? Are we overpaying for the land? Are we in at a good basis? Okay, the basis of a deal is incredibly important as it allows you flexibility, right, to withstand potential turbulence in the market. It allows you to withstand increases to your hard costs or financing costs, right, as we just mentioned with rates going up. So there's a lot of different things that you can tell just from looking at the uses in the capital stack. You can also get a good sense, right? As I said, we look at a lot of deals, 30, 40, 50 deals a week sometimes. You start to notice patterns, you start to notice trends, right? So being able to identify what is the cost per foot that a developer is projecting, what is the cost per unit that a developer is projecting, or on the other side, right, if you're not the equity, if you are the developer themselves, being able to prove out your hard costs, being able to show my hard costs are $230 per foot because I've gone through this with my general contractor, or I've gone through this with multiple general contractors. I've bid it out to people, and this is where the hard costs are coming in at. And I can prove to you that this is a realistic number that we'll be able to build the project for. And even then, we have a little bit of contingency on top of that. Many of you are probably very aware of where construction costs have gone these days. We've seen that on some of our existing projects. We've seen that on projects that we've been looking at, and it's been fairly national news where lumber prices have gone in the past, material and supply chain issues, all that kind of fun stuff. So these are two kind of critical areas that you'll want to be really paying attention to as a developer to make sure that you have a good basis and that you're in a good deal. And then again, the same thing as an investor, making sure that these numbers are in line with where they should be. Again, similar to the debt, right? These can make up 50, 60, 70, 80% of your uses on a project. So getting those numbers right is critical, and being able to provide the supporting data, which you'll either have in maybe a tab in an Excel, you'll have in your presentation, you'll be able to say, I spoke with X number of contractors, etc. So it's a simple way within this Excel to express what there's a lot of data behind, which which Alex will get to in a second here. We have a question, Solomon, go ahead.
Yeah, quick question. I'm looking at the numbers. Is there a general kind of ratio of the cost that we need to be aware when you develop kind of medium
You mean like
size
the percentages here?
Yeah, I mean, is that kind of typical of any medium-sized development with the material to labor, acquisition, land, and all that stuff? I know it's different for every city, every place, every project, but is there any rough that you always use or at least consider when you look at the numbers?
Right. So I would say on a percentage basis, it's tougher. Usually what we're looking for is per foot or per unit. You'll see in, again, New York, for example, you might be buying something for $200, $250 per rentable or sellable foot, sometimes even $300 or $400 if it's a super prime area that you're developing a luxury condo building, for example, and your hard cost might be $450, $550 a foot. So in New York, the percentages of these items might be much closer, right? The land costs, I mean, typically you'd like this to be, fairly low. That means that you're in at a good basis, okay? I would say the hard costs are typically going to be the highest number. I don't really have an exact percentage for you. What we're typically looking for is cost per foot, cost per unit, comparing them against all the other deals that we see in a similar area, right? So we'll typically start with all the recent deals that we've seen in Miami. We'll then start to narrow down to more of the Coral Gables area, and we're looking for similar size projects, similar type of construction, right? So if this is a mid-rise multifamily building that's got about 90,000 square feet of residential space and about 130 units, I don't want to really compare this to a high-rise multifamily building that's got 250 units. I also don't really want to compare it to an office building or a retail building, because those are going to have totally different build outs, totally different configurations and uses. So you want to kind of start with very similar type buildings or size properties, and typically you want to focus more on the rent per square foot, the cost per square foot and the cost per unit, because that's going to be a much better indicator than trying to use a percentage. Because if somebody has owned this for 20, 30 years, maybe the number that goes in here is $2 million, and it's going to skew this to be a much better deal, but you're also going to have this as a much lower percentage as well. Okay. Another box that we have here, we'll come back to here. Just a quick breakdown of the asset, kind of what are we looking at, right? So if this was an office building or a hotel, we'd have office square footage or hotel rooms, right, as a number here, right? But it kind of just gives us a quick breakdown of what we're looking at. And then all of these numbers here are referenced to these cells to show the calculation per rentable foot, per unit, things like that, okay? See a couple quick questions in here. Eddie, is there a number used to determine how much contingency? Very good question. Again, particularly in today's market, over the past, I don't know, 5, 6, 7 years even, I would say 5% was a reasonable number for contingency. That was kind of the go-to number, right? If we saw 5%, we said, okay, that's pretty reasonable. We would expect a project to have that percentage of cost overruns or change orders or delays, right? Because that's going to happen in any project, even the best run project. There's something that comes up. That's why you want to, from our side, that's why we want to invest with experienced developers. And that's why on the development side, you want to have a good team around yourself and you want to build out a budget like this, right? I would say in today's market, probably closer 7.5 to 10% is what we would expect on hard cost contingency. That's what we're going to build into our own internal budget. And that's what we're going to ask our developers to model in. But it goes beyond just hard cost contingency. To a degree, we also want additional soft cost contingency, architects, engineers, permits, all of that stuff is taking longer. It's more expensive these days. So we want some additional soft cost contingency. And we're usually going to ask for additional interest reserve as well, right? We'd rather capitalize this upfront and not use it than need to do a capital call 2 or 3 years into a project because we underestimated and we tried to beat a certain timeline, or we were only optimizing or trying to solve for a specific return, and that then puts you in a different predicament, right? I see from Tao, how do you get the cost on those comparables? So we're about to go into some different comparables here. I'll actually share the screen for Alex to kind of talk about rent and sales comparables. Another really kind of major part, right, of looking at a development, whether you're on the investor side or the developer side, is knowing your market, doing your market research, understanding why you want to build in this area. Why do you want to build a certain asset in this area? Is it condos or apartments or a hotel or office, retail, industrial storage, whatever you're trying to build? Why are you building it there? What is the demand for it? What is your competition? All kinds of things like that, right? So from a rent and sales comps, that's what Alex is about to go into. From a cost standpoint, where we're getting comps, again, is looking at other projects that developers have sent us, so we can kind of use that as a benchmark. And from a developer side, you want to speak with multiple general contractors. You don't want to talk with just one contractor or one subcontractor. You want to make sure that you're speaking with multiple general contractors, multiple subcontractors, multiple third-party professionals, engineers, architects, all that kind of stuff, to make sure that you're getting a proper, realistic cost. That you know that cost is going to hold true, and you can stand behind that cost, and you can build a project budget out of that. Okay, so Alex, the floor is yours. I'll move the slides here for you if you wanted to start here. Yeah,
I wanted to touch on the comparables actually one more time, the cost comparables, because in last October actually is a prime example. All of a sudden we had, I think, about 5 to 8 projects all in the same area that we received in Orlando. They were a little bit spread around, that we had one in the Four Corners area, one in the downtown Orlando area, one in Apopka. But it really allowed us, going through the same process over and over again, the one that Andrew just described, the underwriting in the Excel, it really allowed us to gather that information and then apply it and see, is this an expensive project? Is this cheap? Is the basis good? Are the rents reasonable? It really allowed us to pound for pound compare the projects. And yeah, that's just on a different note also. So here we have an offering memorandum. Typically, this is a separate document that we receive from the developer. So we receive the Excel, the Pro-forma, and then we receive an offering memorandum. The offering memorandum typically is just another word for the business plan of the specific project. And here, I think we shortened it a little bit to just display the most important information. And what's really important when we look at these business plans or offering memorandums is to understand the timeline behind it, right? So how long is pre-development? What is construction, right? Those two actually allow us to estimate the interest reserve that we have to factor into the project, right? Because the interest reserve is what the name suggests, for the time, right, a reserve that we can pay the interest for the time where the project is not cash flowing, right? We're unable to pay the interest. So here, construction goes until month 30. Then we'll have a stabilization period of around 6 months. So even for that period, we will probably need a little bit of interest reserve. And then once it's stabilized, we'll have it cash flow a few months and then look to exit the property in this case. If we move on to the next slide, we will have rent comparables. And in this case here, you can see that the subject property is on the very left, and it is compared to 5 other buildings to the right. And the way that this is organized is, we're looking at the year, we're looking at the number of units. This is specifically important because we want to compare pound for pound, right? Apples to apples. We cannot compare a boutique building that has 5 to 10 units to a building that has 237 units in example number 1, right? Or 443 in example number 5, because those rents will be different. They won't have the same amenities. They won't have a doorman that is there 24 hours a day. It's just a different type of product. So for that reason, it's always important to look at very similar projects in the same area. You can also see we're looking at the same year too, right? So this building here would be constructed in 2023, and the products that we're looking at are no older than 2013. So we try to, limit the amount of comparables that we're looking at to the newer projects out there, right? So 2013 is on the older side, but then you look at 2019, 2020, and then there was one that was built in 2015 and already renovated in 2019. What is also very important, obviously, is the distance to the subject property. So in these cases here, it's all within, I would say the most relevant ones are here within 1 mile, and then we have 2 that are a little bit more than a mile away. So this is obviously important because even from street to street, the desirability of living on the specific street can change a lot. And then, we look at the rents, and here we look at the overall rent per unit. This is actually interesting and something to point out. So if the developer is not including the unit sizes, and then we can therefore not estimate the price per square foot, that's something that we would need to figure out, because there are multiple ways of looking at the price per unit and the price per square foot. In some cases, you can achieve a much higher price per square foot by offering a smaller unit size and then still be competitive in the overall price point, right? So that's why it's important to factor both metrics in. In this case here, you can see that we're right on spot with a subject property at $2,100 for the 1-bedroom compared to the other buildings. We're right on spot actually with pretty much all of the entire unit mix, right? So overall, the average is $2,250 compared to $3,100, $2,800, even $4,000 is probably an outlier here, and then $2,850 and $2,800. So overall, the price point here is very good. That is obviously also an alarm sign. So why are we offering something that is so much cheaper? And then it really gets down to visiting, the competition and really understanding what we're building here. Are we building something that is inferior to the subject properties? Is this something that, is an up and coming neighborhood and right now the rents are just cheaper? What's the reason why we're underwriting something that is on average, I would say $400 to $600 cheaper than the competition in 2 years? At the time it was 2 years, so for next year. If we move on to the,
So I'll take a quick pause. There's a question on occupancy.
Yeah,
So that's okay. So certainly occupancy matters. As we start to drill down even deeper into this analysis, right? And Alex is bringing up good questions as you look at the comps, right? So occupancy matters, right? As you lease up the property, you want to understand leasing velocity. How quickly are these buildings leasing up? Are they staying at a high occupancy? Are developers needing to offer concessions to get people to move in? Are you offering a 12-month lease, but one of the months is free, or a 13-month lease with a month free, and that's kind of skewing the numbers because people are hopping around from building to building? Are they offering different terms of leases, 12, 18, 24 months, and a bit of a discount to make sure that the building is occupied? Okay, those are all kind of relevant questions. So certainly a good question. I forget, I think Matt had asked it. It's also relevant too to look at the size of your units, right? So your rent per foot, and it can be tough if you're not able to get square footage for all the things. If you're designing more efficient units, you may be at a similar price per foot as some of these others, but maybe their units are larger, or maybe on the converse, your units are larger, than a competitor's unit. Okay, as Alex said, amenities, right? I would think that potentially the building that we're looking at, maybe this building with 100 units, could have very different amenities than a building with 237 or 400 units, just based on the total square footage, right? If you have more square footage, you may have more amenities. You go from having the gym and a yoga studio and a dog walk or something like that to also having a pool and a basketball court and stuff like that. So you have to kind of look at all of those items, kind of together as you're making decisions. And as Alex said, the best way to do that is actually walking the properties, understanding the quality of construction, understanding what's in those amenities. How does the property actually look and feel when you're there, as opposed to when you're on, apartments.com or StreetEasy or Zillow or CoStar or something like that, and you're only kind of seeing pictures and descriptions. It's really, really critical to visit, those properties and look at them.
Yeah, also AM asked a question here. If there's a cap on the annual increase for the rents in Florida. I'm not aware of an annual increase in Florida.
Yeah, there's maybe in New York, obviously there's rent stabilized and rent control buildings, and there are certain other markets that have affordable housing, but there's no increased cap that I'm aware of. Top 5 amenities in an 80-unit rental building. I don't know that there's a correct answer to that. If we have any developers that want to give an opinion on that here, please feel free. I would say it really depends on the location, that you're in. I would mention a couple of yoga studio, a dog walk. That maybe if you're in a suburb that has plenty of parks and things like that, you may not need a dog walk. If you're in more of an urban area that's a walkable city, having some green space for your dog to run around, that could be a crucial amenity, right? Having something that you can drop your kids off, some sort of like a daycare thing, could be very important one place, not important at all in another place. So things like that, it will change based on the location. I would also say too, not to for the distance to subject, that also very much depends on location, right? If you're in a market like certain spots in Texas that are maybe more of a drivable locations, having something that's 2, 3, 4, 5 miles away could still be a very valid comp, as opposed to Coral Gables, which is much more of a walkable location, and you want to make sure that your comps are all very nearby to you, because you have a little bit of a small, it's not as sprawling a city as Houston might be, for example. Okay.
Okay. Continuing with the exit comparables. So in this case here, right, we're looking at a project in Coral Gables, and typically the same applies also. We try to, find comparables that are obviously in the same location. In this case here, they're a little bit spread all over the place, but it doesn't really matter, because we're looking for this specific example. We're looking at specific metrics, right? So one way to evaluate the value of a building is the cap rate, is looking at here they have obviously the number of units, right? Is it institutional size? Is it on the smaller end? Again, the same as with the rent comparables, we cannot compare 15 unit building on the price per unit metric with a building that has 254 units like the one in Fort Lauderdale. So we really try to nail it down to the same amount of units, to the same location, and then, you know, different metrics play more of an important role, right? So the cap rate, you can see at the top right, we have for Class A, Class B, Class C, we have different ranges of cap rates. And then obviously, you know, the price per unit plays a role, but this is really dependent on the number of units and the unit size, right? So you could have the same overall building square footage and more units, which would result in a lower price per unit price, right? And then obviously you would also have the price per square foot, and then the cap rate. So these are metrics on the exit that are also very important.
So we have a very good question from Ryan as well. Something very, very relevant to today's market. How do you look at the kind of the inverse relationship as interest rates are going up? You know, what is that doing to cap rates, right? How do we project that? So I would say historically, you know, we've kind of taken the approach of we want to use what's an average cap rate been for the past 3, 5, 7, 10 years, depending on the location. Or certain areas are changing much more rapidly than others. Austin or Nashville, you know, for example, are kind of rapidly growing. A lot of places in Phoenix and Miami even still. You know, so there's been, you know, great outside factors that have caused cap rates in those markets to compress, to go lower, we'll say, right? So in the 3-4% range. There's been a ton of money infused into the market, a ton of capital from all over the place, which has caused cap rates to compress. And a lot of that has also been due to interest rates being so low for so long. So when you're paying 2.5-3% on a fixed interest rate, you can afford to pay more for an asset. You can afford to pay a lower cap rate for an asset, for something, especially, you know, the newer built assets, or really anything from any, you know, 1970s, 80s, 90s vintage. So as interest rates have risen, right, they've gone up now, you know, 150 basis points in the last month or so from the Fed. What that's doing is that's raising interest rates. Since now, instead of getting money at 3%, you get it at 4, 4.5, 5%. Right? Floating interest rates are completely out of whack. Lenders don't want to quote debt terms. They don't want to be giving you something that, you know, 30, 45, 60 days when they close on it, they don't know if that interest rate is even going to be valid. They're going to have to retrade on those terms, or they're offering much less leverage because there's not enough cash flow available from property. So certainly we're seeing cap rates start to rise across the board. People are starting to get better deals for value add properties. You know, so we're very much taking that into account. We're starting to stress our underwriting, particularly on the exit. You know, so whereas once we would maybe look at it at a 5, we're now 5.5, 5.75, 6%. We're looking at lower leverage. We're making sure that there's enough reserves in the capital stack. On the new development deals, I'd say we're still 5, 5.25 on the exit, you know, because I think you're going to see those 3, 3.5, 4 caps start to rise a bit. You know, to take a guess at the market, though, is something we try to avoid doing. We don't try to predict where interest rates are going to go, because I think that's a fool's errand. We're going to be wrong no matter what. It doesn't matter what we do. We're going to be wrong in this. So we try not to predict where interest rates are going to go. We just kind of try to do the best we can with the historical data, and we bet on good locations, good developers, and, you know, strong projects that have good fundamentals that were good today. They'll be good tomorrow, and they'll be, you know, they would have been good a couple of years ago, right? So that's kind of how we try to look at it from you know, from where interest rates are going to where you know, what effect they're having on cap rates. Okay. I see a couple more questions rather than comments. Appreciate you guys giving your opinions in there. To pull data from comps, you're relying on the websites of the properties calling. So Matt, to answer your question, everything, all of the above. We're pulling data from individual property websites. We're going to the StreetEasy's, apartments.com. We're using paid sources like CoStar, Reonomy, Reology, stuff like that. We're calling individual leasing brokers. We're calling developers, right? So we're kind of all over the board, right? You get information from everywhere. And I think still the most important thing is actually visiting the properties. It's great to have all that data, but sometimes you'll have all that data and you look at it and say, this doesn't make sense. I need to visit these properties and understand, why is this property that was built the same year and has the same amenities, generally the same square footage apartment on a 2-bedroom, renting for $300 more than this other one, and they may be even on like the same block, or just a quarter mile away from each other, right? And that's something that you can pull all the data in the world, right? But you really sometimes just have to actually visit those properties. Malik, most banks want a market study in order to provide any type of debt. Yes and no. There are lenders that, if they're maybe more of a national lender, they will rely certainly on an appraisal or a market study or something like that will give them a certain amount of data that they don't have, versus certain local banks, if they're super active in a particular area or a particular location, they may have a lot of that stuff internally, and they may not need a market study because they have the rents, they have the costs, all kinds of stuff like that, right? To be able to know the answers there. Patrick, I was told it's always good to go up a point or half point to protect investments. I assume you're relating to, I'm not sure if you're relating to cap rates or interest rate, but I would say yes to both, right? We try to be conservative in the way that we look at investments. So we're always trying to add a certain buffer to everything, which we'll get back to in a second here on the Excel. Actually, I just wanted to kind of finish up, I think Kip had put in the chat, market research, right? Do your research, understand the market. It's not just about comps. It's not just about sales or the debt or, your hard costs or your land price. Understanding why do you want to build somewhere? What is the reason that you're going to build, in this case, a multifamily rental property in Coral Gables, right? What are the employment drivers to the area, right? These were all new companies that are coming to the Miami area. That has certainly continued and is projected to continue. I think even with what's there now, there's plenty of employment drivers. Proximity to entertainment, retail, food and beverage, nightlife destinations. All those things play a role in why someone might want to live in one particular location over another, why they might want to live in your particular multifamily development over another building. Okay.
Just to touch on that one very quickly, because a couple of months ago we received a project. I think it was like 300 units in the outskirts of Texas, somewhere in Texas, and so 350 units. The town had 2,000 people living there. Right. So that's actually a good example in touching on, the demand drivers is, why would you want to build a unit for every 7th person that lives there? Right. So that's something you want to consider. The numbers could be as fantastic as they could be in returns on paper, but then you're really inflating the market with the amounts of units that you're bringing onto the market. So I just wanted to add that real quick.
Yep. I see a quick, we've only got a couple minutes left. I see a question from Hosea. What percentage of affordable units is best to make a deal good? Will very much depend on the location that you're in and any kind of abatements or incentives you can get from the location that you're building, right? So certain cities will require affordable housing, in which case you may not have much of a say. And I think in New York and certain areas of California, we've seen that, and it's it's restricted new development. It's had the opposite effect maybe of what those policy goals were, because now there's less inventory, there's less apartment stock, and prices are, I think, what, a week or two ago, the highest they've ever been in Manhattan, averaging $5,000 a month. So certainly the policy doesn't seem to be working, with that. I would say from, there are plenty of areas that offer affordable housing, or they ask you to do affordable housing. And in return, you can get a tax abatement, you can get financing from the city, but there's a lot of things that you can, get from the city in return for developing affordable housing. So, that'll have an impact. Take another quick second here. We didn't get a chance to, so we addressed, this entire area, right? This is kind of where Alex is talking. Rent comps, I think I forget who asked, occupancy, right? Making sure that you're kind of projecting the right amount there. Your expenses, and again, this is stuff that you'll have benchmarks to make sure that you're in the right spot on a deal like this. I did want to highlight the debt. Okay, so as interest rates are rising, 2-3 years ago, even a year ago, right, you would have put 4% in a thing here, right? And you look at a project like this and say, okay, well, it's a little bit high leverage, but that's okay. We can still refi out. As long as we build it, get our rents, we can refinance out of this loan. Okay, those are yesterday's numbers at this point. Today, rates are 5.5. I don't even know. I honestly don't know where they're going to be. The Fed just raised them, 75 basis points again. So, maybe rates are 5%. Okay, it's difficult to refinance out this loan at this point. Just based on a 1.25 debt service coverage ratio, which is basically saying that the lender is going to want 1.25 times the amount of debt service, right, on the NOI, because that gives them a little bit of a cushion should your rents go down, should your vacancy go up. So at this point, on looking at a deal like this, you essentially need to say to yourself, the risk of refinancing out of a deal like this, if we're analyzing it, is high. There is a chance that we could build this, and if we don't sell it and we want to refinance it, we would have to come up with $2 million out of our pocket to pay off this construction loan. So we either need to be super, super clear with ourselves, our investors, and the developer that the plan is to build and sell this asset, or we need to look at maybe taking lower leverage, or we need to be, in a worst case scenario, we need to know, okay, we may need to bring $2 million to the table to refinance this out if, a worst case scenario comes along and, we don't want to sell, we want to hold it. And, maybe the cap rates have expanded even beyond, kind of what we would expect for an asset like this. Okay. See, Malik talking about, so yeah, the simple explanation on refinancing. So, this loan here that we're taking is a construction loan. This is typically going to have 24 to 36 month term or maturity. So we are going to need to refinance out of that loan into a permanent loan in the future. And we want to make sure that there's enough coverage to be able to do that. So I think final question here from Matt. I know we want to look at one last slide from Valerie. What do you typically budget for cost overrun? So we address that a bit here in the contingency. We'll also address it here depending on how we feel about the budget, and for a stress test of the deal to say, what, I think there's going to be some cost overruns on the project, or I want to stress test what the returns look like. And we're going to have in the agreement with a developer that, who's funding those cost overruns? Do they fund it? Do we fund it? Do we fund it pari passu, meaning, we fund 80%, they fund 20%. But you can use something like this to check your returns and make sure that if costs do continue to rise, even above what you've budgeted, that the returns are still viable and it's still a deal that you would want to invest in. Okay. So Valerie, if you just want to pull up that last slide, we appreciate everyone joining. It's the end of our session here. this is basically an example of some of the mentoring that we do, the templates that are available to you, right? This is how we look at deals day in and day out. This is the exact template that Alex and I use to look at deals in Miami, Texas, Arizona, California, New York, New Jersey, from hotels to office buildings to mixed use developments, value add. And that's what this course is all about, right? It's the evolution of some of the courses that we've done in the past, hearing some feedback and looking at kind of more specific training and programs, in addition to more one-on-one mentoring, looking at specific deals and giving you some of advice or opinions or thoughts, providing resources to you like the templates or other things like that. Looking at networking both in person and in group sessions, and then having live weekly speakers in construction management, asset management, marketing, investor relations, analysis, financing, capital raise, development, design, acquisition, pro forma analysis, all that kind of stuff, and bringing you live updated opinions from really the top people in in the marketplace today. So appreciate everyone joining, and we look forward to seeing you all again soon.
Thanks, everyone.
Thank you.